You guys know how to, uh-oh,
Get our launch meeting.
how do I get it to get rid of that? You know?
To do what? Okay, so you hit view. Okay, and then gallery, which is already checked.
Right over here?
Yeah, that's
Or
fine.
anywhere?
And then there should be, you want it big?
Well, I guess so. I want that out of the way, right?
There should be something. Yeah, one. That one will make it big, should make it big. Not leave meeting. No, no, no. Not that. Yeah. Hit launch.
Okay, we are live now.
Here?
Mhm. Are you on mute?
Not yet.
If you don't want to be successful, go and down to the ground. He'll give you a call. You can check it.
Somebody needs to mute, something in the background that needs to be muted.
Did you trust the wife of the state?
Who is that? Sounds like a, anyway. Oh, Lord. Okay.
Live, yes, Sue?
Yeah, we are live. Yes.
Can we call the meeting to order or we just gonna go? We're waiting on Christina.
Yeah, she is not here yet. Looks like we pretty much have most everybody else.
Maybe she got tired up. I'll call her and see what's up.
So we can do the roll call vote and get the meeting.
Oh, well, Al, you're the co-chair, Al, so you can go on with. Yeah. I forgot. Yeah, you the man. Okay. Yeah.
All right, we're gonna call a meeting to order for our investment committee meeting on today, July 20th, 2020. Happy New Year, everybody. Sue, can we get a roll call vote?
You said July.
You
This
said
January.
July.
I mean January 20th. I'm trying to get out of school already. Let's rewind. We're gonna call this meeting to order, the investment committee meeting today, January 20th, 2022 at 4:36.
Okay. I'm sorry, Dr. Sanders. I forgot that.
All right, Angela Banks.
Here.
Christina Bennett. Antoinette Cousins. Lewis Cross.
Present.
Sheila Goodwin.
Present.
Donna Jones.
Here.
Yvette Levy.
Here.
Bobby Richardson.
Present.
Albert Sanders.
Here.
Justin Stein.
Here?
Doris Walker.
Here.
All right, we have 9, so we do have enough for a quorum.
All righty, welcome everybody. Happy New Year to everybody. And we have ANCO, our new consultant team. They're online, and I think they're going to go first and with some introductions and stuff and things. I'm sorry, I'm on a professional meeting. They're gonna go. We're gonna introduce ANCO. So I'm gonna turn the floor over to ANCO and Sue.
Okay, good evening, everyone. It is a pleasure to be with you for our first official meeting with you. It's myself and my colleague, Jeff Kutka. And we've been talking with Susan over the past, I guess, month and a half to make sure that we have everything in line for this meeting. And I just want to say before we get started, thank you so much for having confidence in ANCO for us to become your new investment consultant. Susan said that she wanted us to give us a little bit of background on ourselves before we start the meeting, our presentations. So I have been in this game for quite some time. I started out as an analyst back in the days. I don't know if you guys remember a firm called Watson Wyatt. It has changed names over the years, but I started there as an analyst and did some additional training, and I was a junior consultant with LCG. The bulk of my time as a consultant was since 1997 to present. I was a senior managing consultant with Gray & Company. I don't know if you don't remember that firm. I was there for 13 years and subsequently went to Callan in 2010. I was there for 7 years as a senior vice president, senior consultant. I took some time off from the industry for a couple of years, and Mike Welker convinced me to come back in. So I've been with ANCO now for about 2 years, and it's been a pleasurable situation. And fortunately, I have a lot of capacity, so I should be able to spend as much time with you as you need, because I only have about 3 clients right now. And the bulk of my experience has been in public funds. I would say 95% of my experience is public funds. So I know a lot of the challenges that you face, as well as I've seen a lot of ways to try to attack the different things that public funds are coming up against over the years. Okay.
Okay,
Jeff?
sounds good.
Great. Good evening, everyone. My name is Jeff Cookta, and good to see everybody. And as Gwelda said, we certainly appreciate the confidence that you place in our group, and certainly we're going to work our hardest for you to make sure we continue to earn that. So we definitely don't take this relationship for granted, and definitely look forward to working with you all. So my background probably started out very similar to Gwelda. So I'm sort of sneaking up on 30 years, the bulk of that being on the consulting side. I started out with a group originally called Ennis Knupp. I think they might still keep a little bit of that name, but they've since been absorbed by Hewitt and then Aon, and they're part of that conglomerate. But I think some of the folks I worked with back in the day are still there. So started out on that side, and then left there for a few years and worked on the money management side of the business. So I was working with hedge funds and managing fund to funds, and also had a stint of consulting in alternative investments, private equity, and hedge funds before ultimately coming back to the consulting side of the business. So I would say of my roughly 30 years, probably a good 20 plus of that has been on the institutional consulting side. So again, working with a different blend of clients from corporates, endowments, foundations, public funds. Certainly has been part of my strong suit, and also a handful of clients on the Taft-Hartley and Union side. So, but again. I think I bring a unique insight, at least to having sat on the side of the money managers. Certainly when we're going and talking to money managers and trying to uncover what they're doing and how they can add value for your program, certainly being able to look under the hood and ask some of the right questions. That's some unique insight that I like to bring to the table.
Okay.
And that's it, unless there's other questions about my back. I can tell you all my hobbies too, if you like.
No, we know you like.
My wife will tell you there's too many of them.
No, thank you very much. And this is our retirement board of trustees. I think we also introduce ourselves so they know get an idea of who we are. So just give a quick everybody on the line, just give a quick introduction. I'm Albert Sanders, or Dr. Sanders, or whatever they call me. And I'm a teacher. I'm an active teacher representative on a trustee board, a board of trustees. Go ahead, Ms. Doris, since you laughed at me.
I'm Doris Walker. I now work for the prosecuting attorney for the city of Bellefontaine. I am retiree of St. Louis Public Schools. I worked for them for 35 years. I retired in 2017. I am very happy.
Ms. Sheila, go ahead.
Sheila Goodwin.
trustee and treasurer of the retirement board. And I'm a school teacher, an active school teacher on the board.
Bobby?
Hello, my name is Bobby Richardson, and I'm a principal secretary at a high school. And plus, we are the #1 high school in the state
Amen.
of Missouri.
Amen.
And I'm
Amen.
also a vice chair, and I've been on this committee, I maybe about 4 to 6 years, I believe.
Mm.
Okay.
Angie?
Well, welcome. Glad to have you guys here. My name is Angie Banks, and I am an active administrative trustee, and I've been off and on the board for about 10 years, I guess.
Yvette? Is
Hi,
Yvette-
my name is Yvette Levy. I am a trustee on the board for quite some time. Welcome. Very pleased to have you be a part of the team.
I'm Lewis Cross III, and I'm chairman of the board. And I've been on and off the board since approximately 2004. And I represent the retirees, which is about, it fluctuates between 4,500 and 6,000. And our total amount, as I understand it, with active and retirees is approximately 12,500, somewhere in there, give or take.
Wow.
I'm a veteran of 40 years in the St. Louis public school system. And in that time span, I did a lot of different things. I was a coach, and then I was president of the St. Louis Teachers Union Local 420. And then I was a principal of a charter school. I was a superintendent of a charter school. And I was, you name it, and I've done everything on the management side and on the labor side. And I am really, really excited about ANCO. And Welda, I've heard so much about you. I think we've been blessed to have you and Jeff on our team, and I can't wait to see, how well we do going forward.
Thank you.
Justin still has to introduce himself.
Hi, my name's Justin Stein. I work as a maintenance carpenter in public schools, and I'm a non-certified employee then. And I'm relatively new to the board. This is my one term that I'm on. I think it's a 3-year term, I believe, probably into my second year pretty well. So welcome to St. Louis Pensions, and hope you do well for us. Thanks.
And Ms. Donna, did you introduce yourself yet?
No, hello, my name is Donna Jones. I'm currently the Vice President of the St. Louis Board of Education. Been a board member of the Board of Education for 16 years. I wanted to say welcome.
Did we get everybody, Al?
Yes, I think everybody has been introduced unless somebody else got on. I think we're ready to move on in our agenda. I think they have some, we're gonna review our December performance. Is that right now, Ms. Sue?
Yep.
And I should say Ms. Guelda and Mr. Jeff.
That sounds good. So Sue, you were gonna put that up?
Yeah, let me get that up for you. Yeah, so just let me know when you want me to advance.
Okay, good. Yeah, let's if we want to flip forward to well, I guess let me pause here really quick and just say you'll notice the preliminary moniker on that. So, sometimes you may see that, sometimes you may not, just depending on timing and data. And I can tell you from the standpoint of, and again, I don't want to go into a ton of detail, but in somewhat of a truncated time period of hand-holding with all of the managers and onboarding and trying to scrub, what we really wanted to focus on for this first report was just to make sure your rates of return and your asset values and those things were as accurate as possible. So as part of that process, what we wanted to start off with was trying to bring it over and make it as similar as possible from what you saw from NEPC, but I guess with the objective down the road is we start to tweak things and look at benchmarks, and certainly structure and managers and watch list is something we're going to deal with coming up in a quarterly report as well. But again, you'll note when I'm going through this report, and I'm going to even walk everybody through it as well, that we noticed some benchmarking issues that look like they don't completely tie out with the investment policy statement. So while the policy benchmark we're going to see in this report, it's not too far off. There's probably some tweaks that need to be made. So I would say that's something we want to address, and probably from our point of view, the way we think it probably makes most sense to address it is in conjunction with actually reviewing the investment policy statement. So that's, and Guel is going to go over our schedule as well, but that's for a future meeting, that we take a look at the investment policy statement and all of the nuts and bolts and pieces of that statement. And what is addressed in there are, again, all of these asset class ranges, benchmarks, the targets and universes and so on and so forth. So what we want to do is make sure we get all of that tightened up, and then what eventually happens is that then gets tied in. It all ties right into this report. But right now we'd say there's probably just a bit of a discrepancy on the investment policy statement, and I'll show you an example, a little bit of that later. But why don't we jump to the first page, Sue? And this is just a real brief snapshot. And then again, when the quarterly report comes out, we'll have a much more detailed market overview that delves more into the economy and asset classes. But this just gives you a nice snapshot of what has occurred in the markets for the latest month of December. And you can also see the latest 3 months and in the past 1 year and some longer time periods. But again, just gives us a broad idea of what we've seen out there. And certainly what you can see from from a general note of strength, that the equity markets, despite some of the things that we've heard and been following out there with Omicron and inflation numbers, which have been running very high, and the expectation that the Federal Reserve is going to want to come in there and fight inflation much more aggressively than everybody really thought, that's brought a lot of volatility into the markets. So these great numbers that we see here, so if you look at the S&P 500 for the month of December at 4.5%, that's a really solid return, but really hides the fact that we've seen a lot of day up and down volatility in the markets. But the trend nonetheless has still been fairly positive, and that's with the thought that the economy is doing well, but there's still a lot of room to grow. So once we get past Omicron and we can start getting people out there by and large and living life more normally, that there's definitely some room to grow in the economy, despite the fact that it's been so robust. It can even be more robust. So I think that's really what the market's been hanging their hat on. But again, that kind of ebbs and flows from day to day. And if you sort of fast forward to where we are today in January, we've seen some pretty big sell-off days. So we're sort of giving some of it back. And again, a lot of that is just absorbing some of the negative news and what the Fed is saying and how aggressive they might be and what's the overall risk there. It's the risk that they come in and get too aggressive and choke off that economic growth that everybody's been sort of keeping their eye on. So that's been the real trend, but certainly you can see where we've been for the past year. So large cap stocks in the US and the S&P 500, almost 29%. So that's a very robust return. And if you go down a couple lines and take a look at the Russell 2000, those are small cap stocks. And then go down a few more lines down to the MSCI EFA, that's the international stocks, the developed international markets. And then right below that, the emerging markets. So you can sort of see a bit of a trend of what we say is it's been a flight to quality. So even in these markets where a double-digit return like the Russell 2000 at almost 15% is really good, it still lags some of the things that are perceived a little bit more safe, like the S&P 500. So that's when everyone's trying to avoid all of this interim day-to-day volatility, they're coming out of the riskier areas of the market, like small cap and emerging markets, and even some of the developed markets outside of the U.S. and repositioning that. So just a little preface, because it's some of the themes that we'll see with some of the underlying managers within the system. So they certainly are following that trend. And again, from a trend perspective, you can see in those boxes to the right, those are styles of investment, value and growth. Growth stocks, sort of think of those things that are more technology oriented and very consumer spending oriented. Those are the types of stocks that has really gotten the economy through the COVID shutdown. It's the online businesses, the online retailers, things that allow people to still operate and conduct commerce and buy things when we're in shutdown mode. So that's really been a saving area for the overall markets. And if you look at the 2020 returns, that's the box to the right, you can see that huge differential for the full year on growth stocks in the large cap area at almost 40% relative to value stocks that were still positive, but only 3%. So big differential. Again, fast forward to the 2021, and that's somewhat normalized. So you see that at least in large caps, that's balanced out a bit. Growth still leading, but not by as much of a margin. But then as you go down in the capitalization spectrum, when you go to mid cap stocks and small cap stocks, there was actually a bit more of a value premium. And again, a lot of that just coming from the market realizing those areas and those stocks have been so beaten down that they have very attractive valuations. So the market has been coming back to those. So again, I just something why I bring it up in the different segments, because these are things that we're going to address over the next several meetings as we talk about the portfolio and structure and just understanding. Are we diversified as well as we want to be? We know that these things do ebb and flow, and certainly you want to have a good diversification scheme that says we're taking advantage of certain areas of the market in these cycles, and we're not getting whipsawed, and we're also not taking on more risk than we're getting paid for. So those are again things we're going to start to deal with as we take a look at the overall asset allocation when we do an asset allocation study, and as we start to dig into the actual asset classes themselves and structuring to think about, do we want more large cap versus small cap? Are we right sized there? Do we want more international versus US? So those are all areas of structure and things that we certainly want to address. Again, just making sure that if we're taking on risk, we want to get paid for taking on that risk. So not having undue risk in the portfolio. So anyway, the only other thing I want to touch on this page, because it sort of stands out, if you go down to the next on the left side, the fixed income portion, and you can see those returns, certainly with the exception of high yield, very challenged for the year. So again, that's going to be really indicative of what the market is thinking about for interest rates. And so that's an inverse relationship. When interest rates are going up, or when there's expectations from the market that interest rates are going up, they're generally going to be net sellers of bonds. So that's a negative impact for bonds. So that's why we've really seen that weaker bond return. But again, I like to point this out because while the market in general has had some headwinds, the objective is to have a diversification scheme in your portfolio and managers that can really manage through these types of headwinds. And I would tell you that your manager group in this system has done a real good job of that. So we'll see that in the numbers. So I'll pause there really quick and see if anybody has any questions regarding just the general market overview of the economy.
I don't.
Louis, this is Christina. I joined. I apologize. I was on a meeting. I could not get off, but I appreciate you starting the meeting, and I will listen in as we continue.
Okay, Chris, glad to have you.
We appreciate me starting the meeting.
Thank you, Albert. Thank
Al
you.
started the meeting, though. You know, he's the co-chair now, Chris.
I got it. I got it. I just, you just popped up first on my screen
Right.
on the face. Mhm.
Okay, so why don't we flip forward a page? And this should look somewhat familiar format wise. This will show your monthly and 1 year and longer time period returns for each of the composites and also the underlying managers as we go through the pages. One thing, again, I'll caveat, at least from a report standpoint. So when we get the quarterly report, we'll certainly see that asset allocation information, the asset allocation actual versus the policy and differentials, certainly something that we need to be monitoring and making sure we're in compliance with policy and rebalancing correctly. The quarterly is certainly, I would say, the bare minimum for reviewing that. We like to do that more often if necessary. So something that we will eventually add to the flash report is that asset allocation information as well. So just kind of helps us. Sometimes there's might not be something to glean from it, but at least from a monitoring standpoint, we're looking at on a monthly basis what's our asset allocation and what does that look like relative to policy, and are we maintaining compliance? So from a performance perspective, again, just given the numbers that we were taking a look at in the market overview, you can see for the 1 month period, that's all the way at the top, that composite number, about 2.5%. So getting some good participation across the board from most asset classes. Again, you can see where we saw some deviations. Fixed income was going to be a little bit lower. You see that actually, that again, I talk about that value versus growth differential, how that can really change on a short-term periodic basis. And this was certainly a month that it was a great example of that. You see the growth stocks in particular sold off quite a bit. So flat for the manager group and the index at about 2%. And right above that, you see the value stocks on an index basis at 6% and your active manager at almost 8%. So a good job adding some value there. And again, as we go out to that longer time period, you can see where that was a little bit normalized. But jumping ahead of myself, going back up to the top line, you see for the latest 12 months, your fiscal year period, again, still a preliminary number, but you're at about 11.3%. So a good number, a bit ahead of the benchmark. Again, I think we'll see once we can get some universe numbers in here as well in the quarterly report that should rank fairly favorably within a universe. And then as we go out longer term, again, you see the 3 year about 13%, the 5 year just shy of 10%. And the 10 year, again, also shy of 9%. So all of those numbers certainly are comfortably ahead of the actuarial return assumption. So again, as far as objectives and goals, now certainly as we start to look at things, I know from the past reports, we were looking at those universe rankings and talking about what can be done with this structure. So certainly those are the things that we're going to be thinking about over the coming meetings to think about structurally, where have we not been doing as well? How can we improve those universe rankings? How can we consistently be above median? And again, from a benchmark perspective, we need to tighten up this policy benchmark, but again, making those component moves and just making sure that when we are paying for active management in this portfolio, which we are in a lot of different places. So we have a small index portion there in the S&P 500, but otherwise across the board, we're paying a lot for active management, but let's make sure we're getting paid for doing that. So again, that's something that we're going to address in our reports over the coming quarters. I know we want to do a manager fee review. I would tell you from the perspective of how we set up our quarterly reports, that we do manager fee tables in all of our quarterly reports, and we also include in their universe averages, so you can see apples to apples comparisons, what each of your managers is charging and what the universe of other active managers are charging. So again, helps all of us to monitor on an ongoing basis, are we paying reasonable fees? But in addition, just paying attention to each one of these managers and their specific benchmark. Are they outperforming net of fees? Are we getting what we paid for? So those are certainly the things we're trying to pay attention to. So again, not going to dive too much into specific managers on this page, but other than the very robust return we've seen for the past year, and even those 3 and 5 year numbers, certainly driven by the strong U.S. equity market returns we see on this page. We want to flip forward one more page. So here's the small cap manager. So again, for that 1 year period, some very strong returns. They have been behind the large cap managers, and again, that's been more of that higher quality preference from the market. But again, these are nothing to sneeze at. We certainly think valuations continue to be attractive in small cap, and from a full diversification standpoint, we continue to believe it makes sense to have the small caps within the portfolio. But again, certainly for us to take a deeper dive into each of the individual managers and understand what they look like relative to the universe, something we'll certainly cover when we get quarterly returns, the quarterly report, universes, and then also when we do more formal work with the watch list. On an international basis, again, just maybe focusing on the 1 year period, the double-digit returns. So not bad, continues to provide that diversification for the program. Again, something we would say just expectations from where valuations have been with the U.S., certain areas of the U.S. market, in particular, large cap being a more fairly valued, and we might see that come back to earth a little bit. International stocks might get a little bit of a boon. Emerging markets in particular have sold off quite a bit because of that risk aversion, but again, makes the valuations attractive. Again, from a structural standpoint, something that we will want to focus on over the coming meetings of do we have the right size of emerging markets within this portfolio? Given the sizing and positioning, are we taking on more risk than we should, and are we getting paid for it? So certainly something we'll address. But again, we think that these areas of the market they make sense for us to be involved in, certainly from the standpoint of active management relative to some areas of the market where U.S. active managers are having a tough time beating benchmarks outside of the U.S. and also within fixed income that we'll see on the next page as well. Active managers have done a very good job of consistently outperforming indices. So they are, by and large, able to justify the active management fees that they charge. Why don't we flip to the next page? And this is the global emerging managers portfolio. So again, we're still fairly fresh into that program, and I know Gwilda is going to talk a little bit about some activity that's going on within that portfolio, but again, from a global stock perspective, having a good amount of participation, but for that first year, they are behind the benchmark. But again, I think from the standpoint of how we evaluate programs, we're certainly looking at longer market cycles. So we want to take a look at 3 year cycles, 5 year cycles. We also want to be paying attention to risk-adjusted metrics and all of these other factors that to tell us is there actual success for a manager or a program. So right now we're still early in this program, and fully expect that they're gonna be doing their best to make all the right moves and make sure that this is an outperforming program. Flipping to the next page. So here's the fixed income managers. And again, this is why I wanted to speak a little bit about that up front, because if you look at that top line, so we see total fixed income, and right below that, that's really the gauge of the full U.S. fixed income market, and the investment grade fixed income market. And for the full year, negative about 1.5%. So again, those headwinds that we've had from interest rates and rate expectations, and then from the fixed income, your fixed income manager group, a positive 1.5%. So again, while those certainly are not numbers that compare to what we've seen in the equity markets, for a fixed income structure that we use as a diversifier, and in some markets, it's going to be a good liquidity bucket for us. That's and also just a yield generation component for the overall system. That's not a bad return for the environment that we've been in. And again, you can see some of the areas that that we've really garnered that from. So within the core fixed income portfolio, again, I don't want to steal Gwelda's thunder because she had a conversation with the manager at Exponence on the fixed income side, but we were going through our audit of the returns for this portfolio, and that stuck out. And we said, hey, this is a fixed income manager, and the markets haven't been that good. That's got to be wrong. So we dug in and talked to our research team, talked to our onboarding team, and then called the manager and everything else. So that's a legitimate number. I'm going to let Gwelda talk about that. I don't know, Gwelda, you want to jump in now and just give 2 seconds on the conversation?
I did have a conversation with the fixed income team at Exponence. And what I will say is this is not a core fixed income. It's more of a enhanced core, because they invest in different types of fixed income vehicles. They call it differentiated fixed income. So it is a good pairing. It's not something you typically see in a core lineup, but their goal is to be 150 to 200 basis points over the Barclays Agg on an annual basis. So, they certainly have delivered that. And actually, there's a lot more volatility, but you've got 2 solid basic core managers in Manulife and Ernest Partners. So as far as a structure is concerned, it actually has complemented those basic core managers and giving you a return significantly above on a relative basis versus the Barclays Agg over time. So it's an interesting product, and I believe they've come in to talk with you all about it, but we'll give more color on it in our quarterly report so we can see the rankings and whatnot. And I will have also the characteristics, portfolio characteristics. I can tell you how they differentiate from the Barclays Agg. In a quarterly report, we have more detailed information, but an interesting product nonetheless.
Great, and so again, you see where something like that is being differentiated and a diversifier, and certainly from the standpoint of it's not an overly concentrated position in the portfolio. It's well diversified, but when it has these nice environments and they make some good moves, you can see how that really adds some value in a tough environment. And the absolute return fixed income, again, a nice positive return for the past year. Now that's if you see their benchmark that they're currently using, that static benchmark, that's something we're going to address, and I think we're probably going to have a different recommendation with regard to benchmarking that. I would say, given the markets that they're in, that probably that global aggregate that you see under the total it is probably a more fair representation of where they're playing and certainly the risk that they're taking on. So relative to that benchmark, they're doing well. And again, this is probably in a little bit different fashion than Exponence is doing it, but they're still playing very opportunistically on a global basis in fixed income. So really avoiding things that could be yield heavy, going into some corporate securities, governments, also taking on currency positions, and again, just doing things in a very differentiated fashion to really avoid the major headwinds that more, I would say, core and straightforward U.S. fixed income managers are facing. On the tips front, going down again, you can see a very strong return. Structurally, again, something we might take a look at as a overall exposure, but it's done, certainly for this past year, has done very well for this program. And certainly as we've talked about inflation expectations, where we've seen inflation just come in at 7% and the market believing we're going to continue to see sustained inflation, investors are flocking towards these tips. Now, I would tell you from the valuation standpoint, they're priced pretty expensive. So right now they're priced to say that we're going to continue to see sort of 6 and 7% type inflation for the foreseeable future, which hopefully we're not, because that's going to be a real issue. And that's certainly something that the Fed is struggling with right now. But nonetheless, that's where the investor flows have been going, and that's really driven that strong return that you've seen within that segment. Again, Neuberger Berman right below that, again, a positive return in a market that's been challenging. Again, from the standpoint of, I think, looking at risk buckets of this portfolio and structures and what managers are doing, we're probably going to want to look at how we're categorizing that relative to something like a Loomis, because they're both, frankly, doing the same thing, operating opportunistically within the fixed income market. So probably two managers we want to think about in the future in similar buckets. But we can certainly address that when we talk about policy and structure. The emerging markets manager right below that, a negative return, but ahead of their benchmark. So again, that's just following that trend that we were talking about previously on a lot of the investor preferences being towards more developed markets if you're international, and towards better quality across the board. So that's been a negative headwind for emerging markets. Why don't we flip forward to the next page? And here's the global asset allocation managers, so and the hedge funds. So I know we talked a little bit about this component when we made our initial presentation to the board. And these are areas of the market that certainly I think we're going to want to address. While we're seeing some nice, solid, absolute returns, I think the overall factors here that we want to look at, number one is benchmarking. We're probably going to want to take a look at a couple of the benchmarks to make sure we're accurately evaluating any value added here. But also, just for some of these buckets, these are higher fee type buckets, and certainly that'll come out when we take a look at this full fee review. But at the end of the day, we want to make sure, particularly when it comes to hedge fund to funds, where we know those have several layers of fees, and even these global asset allocation managers, that we are getting paid for the risk that they're taking on, and for an additional fee that we're paying. And does it make more sense for these types of allocations to be allocated elsewhere? So again, they've been respectable, absolute return additives to the program. But if you start to pick apart the pieces and say, well, how did their 60% equity portion do relative to your total equity portion and your other managers and your fixed income piece? Did it compare, or would we have been better off having that allocated there? So that's an analysis that we expect to show you down the road. Why don't we flip over one more page? And so I won't spend a ton of time here, at least on the monthly, because we're not getting at least timely monthly numbers from any real estate or alternative managers. A lot of that's going to come out in quarterly and lagged. I know from the watch list standpoint, and something we certainly want to focus on. Again, I think we may have briefly mentioned this at our initial presentation. The UBS fund, that's one that our firm has had on a replace watch list and potential search and replace lists. So I think we're certainly going to want to take a look at that. And with that one, I would tell you right now, you've really been fighting redemptions. They have a lot of they have billions of dollars of money that's looking to come out of those funds. And when any manager is in that type of position, it really, with these lesser liquid strategies, it inhibits their ability to go out and buy other properties. Because whenever they sell a property or have liquidity, they have to figure out how to pay out investors, and they have to sort of manage the process of, well, we've got to pay out some investors, but we also want to invest in a new property. And it just doesn't give them the full flexibility to make the kind of changes to help them move around things, such as office space is kind of weak right now. A lot of people aren't in their offices, and office rents are going to start feeling that. And that's an area of the market they haven't been able to adjust relative to other managers that have had the flexibility to do that. So, that's certainly one of the managers that I know we're going to end up focusing on in the watch list process, and possibly looking at for replacement. But outside of that, we have some new allocations, and Gweld is going to talk about those as well. So I don't want to steal Gweld's thunder on that, but we do have some additional allocations within that segment, and private equity as well. But certainly, again, as Gweld talks about our future meetings and progress, we do have to think about private equity pacing on an ongoing basis, because the fund does have a target allocation. We've been below that, so we want to continue to make sure we have a process in place of allocating and potentially over committing capital. So as we go through time, we get closer and can maintain an allocation that fits that budget. Now, we think that of the commitments that were recently made, that's gonna help move us toward that. But certainly, it's an ongoing moving target of a process and an evaluation and a study that we do on an ongoing basis to make sure we're putting managers in front of the trustees and the committee, and that we're definitely in place to either add on to managers that have been doing very well or identify new managers that make sense. And again, help us with that overall commitment level and keep us on target with that asset class. Because again, it's a diversifier, it's a return generator for this portfolio, and certainly exposure that we think makes sense for the system.
Okay.
With that said, I will pause. Maybe before I kick it over to you again for your final items, if we can go back one page. And I do want to talk about, because we did put this on the agenda, is to talk about Entrust, because we have this $1.6 million piece that sits there, and I think everybody probably scratches their head and says, what is this? Why is it there? Why do we see these negative returns, and we're continuing to pay fees on it? So this is really an offshoot of what was once Entrust's fully diversified fund of funds portfolio, and when that liquidated, they had one position with a manager, Gramercy, and Gramercy had basically one position, which was in Peruvian debt. In particular, not to go into too many weeds on this, Peruvian land bonds or agrarian bonds. And so just a long story short on that, if you go back to the late 60s, early 70s, the government appropriated a bunch of property. And in order to compensate those citizens that they appropriated the property from, they said, we're going to give you government bonds and that pay a fairly decent yield. So what naturally happened over time is that people that said, okay, we have a bond here, it's giving us a nice income yield, but if I could somehow, and I would say it was probably more of the result of the financial industry came in and said, hey, why don't we offer people a steep discount to take the bonds off their hand right away, and then if the government continues to pay these, we as a money manager do extremely well down the road. Well, what invariably happened is I think the government saw the flow of all of these things getting repackaged and sold to, frankly, a bunch of U.S. hedge funds and investors that weren't citizens of Peru, and said, well, why are we still paying these things off? And so they stopped paying, and it ultimately defaulted. And now you go through what's been multiple presidents and administrations in that country since then. And every time a new president comes in, says, oh yeah, we're going to take a look at that and try and figure a way to work this out, then nothing happens with it. So Gramercy sort of, I would say, made a miscalculated bet on this, that they could come in and be an agent of change and get the government of Peru to make good on these bonds. It hasn't happened. It's now in global arbitration, and I guess from at least from what the managers told us, and I sent over everybody the memo and the note that came back to me from Entrust. So I think expectation is it's going to get arbitrated, and if Gramercy and all the bondholders win in arbitration, they expect it's going to go back and it's going to get appealed and it's going to continue to get dragged out. So. I guess long story short is, Gramercy says they can liquidate the position today, but it's going to be at a steep discount. So in their mind and their recommendation, they would keep holding it, keep trying to fight the good fight, and hopefully have this thing pay off. But I'd say unfortunately, this for the time being, it's just it's in a holding pattern. So.
Would you suggest that we do something with it now, or still just hold out?
Well, I guess there's not a whole lot that there's really only one option that we would have, and that would be the secondary market. And I think we would have to explore Entrust's legal documents as part of that to see if they even allow that for us to take it to the secondary market. I suspect that whether Gramercy / Entrust takes the Peruvian bond position to the market and sells it, they're going to get a deep discount. And I suspect if we just try to sell the Entrust position itself in the secondary market, we're going to take just as bad as a hit.
Right.
So I think probably we can poke around and see if there is some sort of bid out there for the Entrust shares. If there is, someone says, yeah, we'll give you $1.5 million for those shares, then I would say it's probably worth it, to get out even on the position. I would say if it's at a steep discount, it's just best to continue to let them work with the government, try and get arbitration, and maybe we get a fair ruling and they pay this off at some point. So
Okay.
I guess from a positive perspective, again, it's not a massive position in the portfolio. So when it does get valued up and down as we see it's been doing, it's not putting a major relative performance hit on the total system. But again, we'd like to deploy every nickel as favorably as possible that we can in this plan. So
Okay.
Yep. And I guess the only question I had, this is Christina, is that when we look at our investment guidelines and we've revised them over, some type of these type of investments, I have no idea if they were prohibited or not prohibited within the scope of the contract. I mean, within the contract, probably it didn't state that detail, but on our investment guidelines, I mean, buying Peruvian bond, I mean, again, we in hindsight, that was a detail on the investment decisions of the managers that were managing this portfolio. But some of the stuff like that, to me, that would have been a lot higher risk than we would have wanted to take on a portfolio and not even knowing it until liquidation, correct? So It's been in this position for a while. I guess we have to ask our auditors if we, write it off and so that we're not showing it. And then if it gets recovered or whatnot, then we can show, a recovery. But I don't want to also deceive anybody on our investment reports and not include it. So I think the best decision is to ask our accountants whether we write it off on our books and then, still maintain the asset and hope that it gets, recovered. And if not, if you sell it in the secondary market, we've already taken a loss and it's just an accounting issue to compare a loss to a loss or a gain to a loss and any offsets. Correct?
Right.
What is your recommendation?
I think I guess from an accounting standpoint, I would say I would agree. Check with what your accountant and what the auditors think about that course of action and how to handle that. Again, I would say just from the standpoint of being a fiduciary, if we have, I guess, a manager who ultimately they're the fiduciary, and if they're saying, well, we still think there's value in this, we're gonna fight to get the value out of it, then we sort of have to defer. And then I would say if we're going to go to the secondary market and sell at a steep discount against the manager's advice, then I'm not sure if there's total prudence in that. So I would say our initial recommendation would be to continue to hold it, but again, subject to what your auditor thinks about how to actually report it and account for it. And then certainly, I think going back to the manager and saying, what do you know about the secondary market for these shares? Is it even allowable by your document? And if that's the case, what sort of valuation can we get? And we can certainly bring that back to the board with a recommendation and say, oh, if it's a favorable, if someone's going to give us 100% here on the dollar, then we would say take it. But then we'd have to, I think about what our pain threshold is on it. Is it a 70% discount? Is it a 50? Is it all the way down to 60? I mean, we'd have to see what the market bears.
That sounds good.
Again, and this is, I really appreciate the new eyes and the new looks on things, because in our investment guidelines, it says that every manager has to comply on an annual basis with our guidelines. And while we have pushed NEPC to get those, they informed us that they get them and they were okay, but we never got a verification that these managers looked at our guidelines and gave us a written letter that said they had complied. It was always assumed that NEPC was doing it, but again, I want us with fresh eyes to be able to go over those guidelines. And if that is something that the market is doing today or is not doing, that's been in there for over 20 something years as a guideline. I want us to be able to replace that with what are managers doing on an annual basis for compliance with people's guidelines, what verification, validation, something that we should be able to check off. And if you as our new consultant says we receive it, then we get a letter from you that says we're reviewed and whatnot. So we want to tighten the box now, but also be compliant with what the norm is in 2022.
Right, that's a great point, and that's certainly something that I think I fully agree should be tightened up, and I know as we look through the guidelines, and that's why we want to address at a coming meeting those guidelines. And I would tell you from the standpoint, we'll take a look at it, but generally, I know when we're crafting guidelines, we try to be somewhat sensitive to, in particular, a fund-to-funds manager. That we would say commingled within your guidelines, would say commingled managers are sort of subject to their prospectus and internal guidelines, because if we start putting things into our guidelines that say, no Peruvian debt or picking specific securities, then it becomes real tricky to employ some of these diversified commingled strategies, because in this type of situation, certainly they could run afoul. But no, I agree. At the bare minimum, we need to take a look at the guidelines. We need to tighten them up, and also need to make sure that they are sent out and refreshed, and that all managers have them, and that they are in compliance with the guidelines.
Good.
So that's a great point.
Okay.
And I can check with our audit firm on the possible write-off of interest and see what their thoughts are on that.
That's fine. Sounds good.
So great. And unless there's other questions either regarding Entrust or on the Flash, that's all I had.
So we can move to the calendar if there are no questions from the trustees.
Okay.
Guelda, forgive me, I'm going from office to car. So if I drop off, I will get back on.
Okay, no problem. Well, Jeff and I put together a proposed agenda. This is fluid. We can change it. We can move things up. We can, move things down depending on how quickly we can get this done. But as you see here, we have put in something for every month for the fund. Next meeting, we plan on reviewing the flash report for January. We will go through the fourth quarter reports, and in that we will be doing more in-depth commentary on the individual managers and how they offset each other within different segments. Also, there's a watch list that you have in your quarterly reports, and we'll also talk about that. I know in the past, from my conversations with Sue, there hasn't been a whole lot of, I guess managers only come in when they are in trouble. So we can explore whether or not you want to see them on a more regular basis before they get in trouble. It just depends, because you do have quite a few managers. And as Jeff mentioned, one of the first things we want to do is to review the investment policy and the watch list guidelines to make sure everybody's adhering to what's in the policy for their particular mandate. There are some discrepancies, as he mentioned, with respect to the benchmarks and whether what's in the policy matches what's in the policy benchmark and the reports. Basically what we did, we took the information that was sent over to us by NEPC and made sure that the flash report and that the benchmarks matched. But we do have some questions as to whether or not some of those benchmarks are appropriate for the particular managers that you have in place. So that would be, so the February meeting is going to be a pretty hefty meeting. But we would like to go through those things. That's very important for as a guiding document for us for the rest of the year for the plan. After that, as you can see in March, we're looking at an asset allocation review, whether or not you're allocated most efficiently to meet your objectives. In the asset allocation review, we'll put together some various mixes and have education on the risk tolerance of the board with respect to how you're allocated. If you're taking on too much risk, if you're taking on too little risk, we'll review all that in the asset allocation review. What follows after that is manager structure. So within each of the asset classes, we're going to look at the managers that you currently have in place. Are they a good fit as far as do they offset each other, or do you have a lot of duplication amongst managers? We want to try to make this portfolio as efficient as possible, and also review the managers if the manager's performing well within their respective asset classes. So those are the big picture things that we'll do within the first few months of working with you. And then after that, Sue told us that she normally does a rebalancing. So we will put together a rebalancing recommendation in the May meeting, or put forward to you. We will work with the Sue prior to that to put together a rebalancing recommendation to make sure that you have enough funds for benefit payments and expenses. So that is in May. And then June, we're about mid-year. We have education session here. We need to find out from you what things that you would like to have us talk to you about. We have some ideas of things, but we want to make sure that whatever Jeff and I bring to you as far as education to the board, that it is something that you're interested in hearing about. So that would be the June meeting. If you can move forward to the next page. And as you can see here, we've left some openings as far as what we want to discuss in the latter part of the year. So a lot of the heavy lifting will be done in the first half of 2022, and we can make some moves along the way, or suggestions along the way of what you'd like you all to see in the latter part of the year. One thing that we will be doing, as Jeff mentioned, is a pacing study. Typically, we put that together about the end of the year so we can see what distributions you've had, where your private investments fall as far as your percentages that you've allocated to them. And we put together a pacing study so that we stay on target. You tend to have to over allocate to private assets because they pay in and it brings your percentage down, which messes up your asset allocation over time. So this is just like I said, a draft schedule. It's up for discussion. We can adjust things, but this is just to give you an idea of where Jeff and I are thinking things will go in the first year of us working with you.
Well, one of the things that we were concerned about was that a lot of times some of the companies were folding up, and we didn't have any knowledge of it, and seemingly the company that represented us in some instances didn't tell us anything, and then the next thing we knew, they had folded up, or they were getting ready to fold up. So what do you all do in your process to alert us to those kind of things?
Well, on a regular basis, our analyst department is in contact with the managers that manage for our clients. And so we get an update on what's going on within the firm on a regular basis, on a quarterly basis. So we should know ahead of time. And with us, we won't wait until necessarily a meeting to occur to tell you this particular manager is in trouble. As soon as we find out, as long as we can to make it publicly available, we would get a memo out. Jeff and I put a memo together, send it to Sue, and she can distribute that to the board. So we don't ever want you to be in a position whereby you're the last ones out, or the company has closed down and we got to figure out how to move it from active management into maybe a passive management. So no, we stay on top of that on a regular basis.
That's fine.
At the very least quarterly.
That's great.
Sure.
Okay.
I know something. I know something we've been like the last couple of years where we've been trying to do some education for the trustees,
Uh-huh.
and I know you got a pact, every month. But is it some? I mean, is it somehow like and I'm sure we can talk with Sue and Christina, but like some of the stuff, like give an education about the what's going on, and not just tell us what's going on, because I think it'll help a lot of us who don't know exactly. I mean, yeah, we know we're investing, but we don't know exactly what's going on. Just to give us a little education. I know some days, some months, it probably you can have a lot of time. Other months, it probably just be a quick, okay, this is why we do this. But I think we need something in there for that.
Like on the prior, like in some of the earlier months, when we do the asset allocation review, we do manager structure, those types of things. We also make that kind of an education as well. We put in a component of education in those reports, talking about why you have asset allocation, what's the the construction of it. So it's an asset allocation review along with an education session on that particular subject matter. So there's always going to be some education involved when we do these big picture things, like the manager structure. We'll talk about why you look at a manager structure, and then also show an analysis of how this manager pairs with this manager, or do you have duplications? So in our, like I said, some of the big picture reviews that we have in here, there will be an element of education when we do those.
So, Walter, this is Christina. I really appreciate what you said. And one of the big issues that Angie and I have been really we're talking to NEPC was about the correlation of our managers, because we just, whether it was quantitative, qualitative, we are overloaded on some asset classes, on managers and numbers. And so historically, right, wrong, or indifferent, we made the decision like, oh, we want to give both managers an opportunity. So we would split an allocation. But we never, ever looked at the quantitative correlation of those managers. It was always on a qualitative on our books. And so bringing that perspective is going to help us quite a bit to, I'm not saying to prune our portfolio, but if it makes sense and and the correlation is equal or not working in the right direction, we need that education and analysis as well.
Yeah, and that will be part of the manager structure review. And we'll be looking at the managers and say, how alike are the managers, like the managers in your equity portfolios or your fixed income portfolios, or how do they balance each other out? It's not optimal for you to have two managers doing the exact same thing. We're looking for in the big picture asset allocation, we're looking for non-correlated assets, number one, but within the individual manager structure in each segment, we also look for managers that do things a little differently so that you're not all going in one direction. That makes the portfolio more efficient, and it also smooths out the return in case you've got a value manager that's perfectly correlated with another value manager, almost perfectly correlated, and they're doing things the same way. And then there's different kinds of value managers, relative value, there's deep value. So you want to make sure that, and that's something, like I said, we'll talk about in the manager structure in April, how the managers pair with each other in each of the segments. That's like a drill down below asset allocation when you look at manager structure, how like in your portfolio, how these growth managers pair together. Like in fixed income, I see you've got 3 fixed income managers, but it's very evident that the Exponent's portfolio is not going to correlate as well with the other two, because it does things totally different. It's a whole different way, and that explains their performance, which we can get into more detailed discussion about when we do the manager structure and review. But that's something Christina will definitely take into account and educate the board on when we do the manager review and manage on the structure of the fund.
Yeah, and the big thing too is we do have, when Lewis came chair, he assigned co-chairs, and we also added like an education component with chairs. So we had an outline list of ideas that we were trying to put on the schedule.
Okay.
Looking forward. So if we can revisit that, any recommendations that you and our education chair recommend is probably totally fine with the board because
Okay.
again, we've been really focused on educating all trustees on as many asset classes as we can
Okay.
because we have such a big portfolio with various managers, and it seemed like every other month we were hiring somebody. And so I'm glad we're taking a pause. We're looking at our portfolio and we're able to, reevaluate on all levels. And I think all trustees will be able to benefit from all of us learning how to dive deep into our portfolio. So I appreciate it.
Sure, absolutely. Okay, are there any other questions on the tentative schedule? And we will weave into, and who is the education chair?
Oh, Sue?
Yeah, we have co-chairs, so we have Sheila Goodwin and Doris Walker. It's actually, the committee is the trustee business committee. And so they handle education as well. And there was a list prepared, I think back in 2020, and I can send that to you. It's a wide variety of topics, not just on the investment side, but I can send you what was prepared.
Okay, that's good. And we can weave that into this schedule.
Yeah, and Gualdo, the biggest thing is you said we have a lot of managers. We get that, but consultants, individuals can be gatekeepers, and we decided in 2020 that we wanted to hear from our managers, and that's why we instituted the education component, because it gave managers the opportunity to come in and tell us about their portfolio, because we do have turnover, right, on our board. And so, and we've had longstanding managers that have never come in since the day they were hired. And so that was kind of the goal, is to, the education component would be coordinated by the consultant, but might be provided by a manager so that we get to see who's investing our money.
Okay, yeah, that was one of the things I remember speaking with Sue, that she mentioned that you hadn't had a lot of managers come in, and they typically came in when they were in trouble. So that was what I was mentioning early in the conversation, that we might get a schedule together where we might have a manager come in to talk about what they do for you, and an update in the organization on a regular basis. We just have to determine how many we want to try to get through in a course of a year, because you've got quite a few managers, and which ones are probably the ones we want to start with.
Well, are you saying that possibly going forward, we might not have to have, or might want to change up the whole process and have fewer managers?
Well, I'm not saying that we won't know that until after Jeff and I do a deep dive and look at the manager structure. There are probably some inefficiencies in the portfolio we might recommend that you might want to trim back on some on managers and different allocations. But what I was saying with that is for the managers that you do have, especially those that are on the watch list, I think that would be the priority, is to get those managers in first. And then we want to, I think, it's important, like Christina was saying, that the board know who's working for them, what they do. So we'd like to get on a rotation of bringing managers in to speak with you.
Okay.
It wouldn't have to be a long, it could be like a 30-minute presentation. It's not like it has to be exhaustive, but you need to know updates within the organization, what they do for you and how they perform and what their outlook is going forward.
I see. Sounds good to me.
Okay, are there any other questions or further conversation that you all want on the schedule? Okay, if not, Sue, I'm not sure who you have up for. I know we've got the private managers. I don't know which ones you have in the first in the lineup.
Yeah, I've got them all together, so you can tell me which one you want to. I kind of just did them in
alphabetical order.
Well, when we did them, date order.
Okay, let's do that. Okay, let's do that.
Started with Kane.
Okay, Kane Anderson is a manager that that NEPC recommended back in, I believe, is in October, and the board committed $5.5 million to it. We know Kane Anderson, and they're an alternative real estate manager. that include office buildings, high-end senior housing and campus student housing, and self-storage in their lineup of lineup of properties, excuse me. And our real estate specialist went through and reviewed everything, and we don't have any, there's no red flags. We were basically asked, since we're the new consultant on this, to see if there are any red flags that the board should be concerned about in investing with Kayne Anderson, and we don't have any cause to hesitate. And I believe the allocation was actually, the call was actually fulfilled. Was it November or December, Susan?
We've actually had multiple calls with them, so.
Okay. Well, that has been fulfilled. So we don't have any problems with you all going forward with that investment, and it's too late anyway. The next manager that was reviewed was HarborVest. And HarborVest is a private equity fund of funds manager. We're familiar with HarborVest. Actually, we've done some work on them on this program in the past. They are the majority of this program is in buyout. The biggest part of this particular one is in buyout. The remainder in growth and growth equity and venture. We actually don't have any issues with them. We decided, we as a firm had reviewed them for possible inclusion and with some of our portfolios in the past, but we found another manager, fund of funds manager, that we, for no reason other than we decided we like them better. But we don't have any issues with them. They have great succession plan in place. We're familiar already following this manager, so we didn't have any problems with you going forward with this investment with HarborVest in your private equity program. But it's a fund of funds type situation, not a direct. Aledade is a real estate manager. You have committed HarborVest, I'm sorry, HarborVest, you committed a $5 million allocation to them in your investment committee meeting with NEPC last fall. The next one is Aledade. It's another real estate manager, commitment of $5.5 million. We know this fund well. We've done quite a bit of work on it. Actually, it's in several of our client portfolios at ANCO, and it's a indirect exposure to in this particular manager to industrial type office and life science and technology companies. So we're fine with this one. This is one of our managers that we have actually recommended with several of our clients. So Aledade was an easy one for us, and there are of course no red flags because we're recommending this across the board in our current client portfolios. The next one is another real estate manager. You already have basis in your portfolio. There was a commitment of $8 million to basis made. This is an MWDBE manager, and it's a little different, and it's making acquisitions through AAA commercial mortgage-backed assets. They primarily focus on origination and investment in commercial real estate facilities and cover real estate sectors, including multifamily, retail, office, industrial, hospitality, senior housing, self-storage, and manufactured housing. This would be considered a value add. The return on this is a 12 to 14% is the projection of what they're saying that they will do for you. We don't have any issues with this one as well. With the going forward with your investment in basis.
So Gwilda, I have a question for you, and
Sure.
Maybe talk about this internally. And we ended up doing this the last several times with some of our managers, but I want to get your input and forward thinking on it. And so, if a long time ago, not anytime soon, we never rewarded managers in our portfolio who did well with like a previous fund. So we asked NEPC to look at that and say, hey, look, you know, again, we all know, you know, Linda Jordan, I know Linda Jordan. Linda, we had Mesereau when she was with Mesereau, and we just would never look at Mesereau again, even though they did well for us, you know. And so Kristen would look at previous funds and say, hey, they're raising another fund. They did really well for you. You know, we're going to make this a priority. And if NEPC recommended, they, and I'm not saying the process was flawed, they brought them up on a fast track review. So they gave us an updated, they presented it. We never had them come back again in to discuss what the new fund was doing. It was just NEPC reviewing that process for us, right? And so I want, you know, as we go forward, to let us know what, you know, how you would recommend an asset in a certain category, looking at previous, you know, managers who've done well in a previous fund. But the issue for me is making that, you know, I'm not saying to make it a priority or a preferred fund, but putting some process in place that we understand, because there's a couple of times where we're like, they're going to close in 2 weeks and we want you to, you know, make an investment now because they were so great before. And we did it, you know, Vista was one of them. Basis is another one that we did. But maybe, you know, since we're starting all fresh, we have a new process in place that you recommend.
Okay, what we typically do, and that's part of, we do a private equity review as well as a pacing study. So in our private equity review that we do for our clients, we go through the whole private equity portfolio, or I should say the alternatives portfolio, whether it be private equity, hedge funds, real estate, private debt. We go through and we do a review on each of the managers to see how they've done. And in addition to that, our researchers are in conversation with your managers. So we know they're saying, okay, we're raising a fund next year, or we're raising a fund in so many months. And if that manager has done a good job for you and we're trying to fulfill an allocation in one of those areas, we will bring it back to you and say, look, so-and-so is raising a fund. We're going to recommend that you reinvest with that manager. They've done a good job for you already. And so it's not like a hurry up type of situation. Like for instance, what we would do, like if we were in place at the end of 2020 and 2021, we would have done a private equity pacing study. And we'll say, okay, you need X number of dollars in this particular bucket in your private equity or your private debt or in your real estate. And then we would first look at the managers that you have already before we bring, because otherwise you end up having a whole slew of managers that you're having to follow. Whereas a part of the thing with the private alternative assets is you reward and you develop a relationship with the funds that you already have. They've done a good job for you. They've proven themselves. Why not reinvest with them if they have a fund coming to market? The thing is about private equity, private debt, and real estate, sometimes they don't have things coming to market. And that's when sometimes we have to go out and look for new managers. But that's part of our process. We always go back to the ones who perform well for you first before we bring new ideas to you.
I appreciate it. Thanks.
Sure. And there's one manager I know that's coming that she also committed to with Fairview, and they're in conversation with our private equity group now. We don't foresee any issues there, but we'll be getting back to Sue with a document, a memo as well for Fairview. I think that was one of the ones that was also committed to back in the fall of last year.
Yeah, and the big closing hasn't happened yet. So we haven't committed capital there or with Aledade. Aledade, we submitted paperwork kind of early, but no capital has been called yet.
Okay, yeah. And but neither one of those that we have any issues with, no red flags with either Aledade or Big. So I'll go forward with that. Any additional questions or discussion on the privates? If not, I think the last thing we have on there is Exponence Manager replacement.
Yes. Yeah, so this was sent out to the board earlier today.
Sue, I'm logging off and logging back in.
Okay. Let's see. Here we go. That up.
Okay. All right. Actually, I had a conversation with Miss Williams as well as her team regarding this. This is regarding the Fund of Funds International Portfolio Exponence Managers for the board. They have full discretion over adding or deleting managers to the program. And this actually came pretty quick to them, and they took quick action. Unfortunately, had another manager that could fulfill it. But within the Exponence Fund of Funds portfolio, there was a manager, Applied Research Investments, and the Chief Investment Officer, Mark Lynn, has left Applied Research to look at other opportunities.
Right.
And he was a key person in the portfolio and research. So in speaking with Tina in the group, Tina said that they were not comfortable with the coverage that they would have going forward in the segments that he covered, as well as he was a key person in the decision maker in the portfolio. And that is something that's critical when you looked at past performance. You're looking for, okay, this is what we're buying. Well, the key person is leaving, so Exponence made the recommendation to transfer or terminate the Applied Research contract and to move those funds to portfolio Redwood, which is a women-owned firm out of Massachusetts, had about $2.1 billion in AUM and about $550 million in the EFA equity strategy. It's a combination of quantitative and fundamental, and they have full confidence in. They've been watching them for a while. So basically, Tina put together the memo to inform the board that they were recommending, they had terminated Applied Research, and they're going to transfer the assets or transition the assets over to Redwood, and that's the extent of the memo. And she also put together the performance, which is on subsequent pages in this memo. I see, yeah, hopefully it's not too tiny. That shows the this shows the how they are like red. Can you bring it down a little bit? This shows the style of the two managers.
Okay.
Okay. And then if you flip over to the next page, you see they're purely in the growth column. And then you can see also here, basically it's one for one, you see that the Applied Research is also in the growth space. So they are both growth managers. So one's replacing the other. Redwood's replacing Applied Research. And then the next section, I believe, is the, it shows the returns of Redwood versus the indices. And as you can see here, the manager has performed well on a quarter to date and calendar year to date, 1 year and 3 year basis. So they're doing well. And then the next page, I believe, is the differential between the, no, this is applied research. It's showing the performance of the manager they're getting rid of. As you can see there, their performance isn't as strong if you were to look at them versus Redwood on the prior page. The Redwood performance is actually stronger.
It's great.
Yeah, and then the last page shows the difference in portfolio weights between Redwood, the new manager, and applied research. As you can see here, they're taking a very strong bet in consumer discretionary information, and they've reduced their significantly less in information technology, and their other area where there's significant communication services between them. It's showing a comparison between the two. But obviously, based on the returns that we've seen from applied research from Redwood, they have made some good decisions and been able to deliver returns. So that should enhance the composite return for the Exponent's international equity portfolio, keeping in mind that hopefully they will continue as they have done thus far with their returns. But just wanted to give you a kind of a rundown on why that change was made in the Exponent's portfolio, which Tina totally outlined in her memo to the board.
Okay.
Okay.
And if anybody knows numbers, it's Tina.
Yes, she does.
Yes.
Okay. Are there any questions that you would like to pose to myself or Jeff? Or things that feedback on what you like to see done that we haven't already covered, or going forward?
Very impressed with the presentation.
Yes,
Very
I'm looking forward to the proposals and recommendations,
Mhm.
And looking at the whole picture for this entire calendar year, where we take a step back and we get to, one, re-educate ourselves on our portfolio, but really take a deep dive into
Right.
some of the fundamentals that will help all our trustees better understand, as well as this will help Sue and her staff better understand in detail the reasons why we did certain things and why we're making changes. And so she's going to have the benefit of understanding the changes and implementing them if we do make any going forward. Again, you're at the same situation. You've inherited a portfolio. Sue inherited, longstanding policies, procedures, and so it's a good time to really reevaluate, re-educate, and reassess ourselves into this portfolio going forward.
Well, we are excited and looking forward to working with you all and giving you our best and making this as efficient, optimal portfolio as possible.
Sounds good.
Jeff, would you have any parting?
No, I think that all sounds good. And I guess if there is a kind of an overriding theme, I think is certainly education, transparency. And I would tell you, those have always been our hallmarks. And I think you can you can tell from something like an Exponence that's a news item for us. And while Exponence has discretion on doing that, we still think it's a major item. It's worth noting. And those are the things that we bring in front of you, and we shouldn't be the last to know things. And so that's certainly what, we pay our research group to be ahead of these things and to make sure that we can get these things in front of you. So they're not last minute, but again, kind of going hand in hand with education. And again, I think just from being refamiliarizing with pieces of the portfolio and education, that having a manager in and getting reacquainted. And again, this could be a multi-year process because you have a lot of managers, but I think just getting a thoughtful rotation of managers through to get everybody refamiliarized, and an education program just helps from a total understanding, transparency standpoint. And again, to us, this is every penny counts in these programs, and it's your money, and it needs to be maximized, optimized, and we'll do everything to make sure we help you do that.
And I also want to say that both Jeff and I, you have our contact information. Please feel free to reach out to us if you need to in between. It's not like we're here once a month, but we're available in between.
Well, what I'd like for you and Jeff to look at is our, who did we just have into? Our actuary, our 5-year experience study that was just completed. And the recommendations there, and really just maybe provide us some comments. More so much to Sue rather than waiting for us. If you get to do it before our next meeting, if you can send that to Sue, just so we can have those discussions, because the experience study was done at the end of the 5 years for NEPC, and now we're going into a new structure. And if they're recommending changes and interest rate outlooks and portfolio characteristics, that we want to take that into account as well.
Okay, that'd be great. And plus, that would also help us in our asset allocation work that we're planning on bringing to you.
Right. I mean, certainly that's something we take into account when we do our asset allocation studies. And again, not to get too far ahead or off topic, but I think if your actuary is like most out there in what's going around in the industry, they are looking at bringing down return assumptions. And Gweld and I have had this conversation because we are going to do an asset allocation review. And just want to give everybody some pre-reality on that the assumptions that are out there that everyone's using. And again, assumptions are always wrong, but nonetheless, we have to use them. Actuaries require them, and they have to be out there. But the assumptions are a lot lower. So it's I think for we're probably going to show you something that says, hey, a 7.5% return assumption is tough, and that's going to be a conversation to have with the actuary to see if it's still supported. I know I err on the side of I think everybody's assumptions are probably a little shorter sighted than they should be. I think for a pension fund, particularly one that's well funded, that I look at it as a perpetuity, and the time horizon is very long. The longer that time horizon, the higher your assumptions can be. So we always try to caveat that the assumptions are probably more short-sighted than you see. So let's not completely buy into it. Let's think of stuff in the long term and maybe meet somewhere in the middle. So, but I can tell you that's a battle we have a lot with actuaries, because I mean, sometimes there are plans that are 8%. And those are the ones we say, maybe you need to start coming back to earth on something like that. But we've got situations where we have 7% and actuaries are trying to get them to go to 6.5. And I think those are the ones where we have battles and say, listen, if we think long-term that the equity markets are only going to give us a mid-single-digit return, but we're still taking on double-digit risk, the environment doesn't work, then why are we providing capital by taking on that amount of risk and not getting paid? So again, that's not to get too far off topic, but yeah, it definitely, all of that has to go hand in hand with what the actuary is thinking.
Yeah. So yes, if you just send those over to Jeff and I, then we'll go ahead and get cracking on that.
Yep, will do.
Yep. And since my co-chair looks like he's pumping gas, I was going to have him close the meeting since he opened the meeting.
I'm ready. I was putting kids on the bus, after school bus.
I wasn't sure if you were pumping gas or not.
No, what's funny is I need gas in my car though. But thank you all for attending the investment committee meeting today. We thank you for being our new person to lead us to making all this good money, all the big money. And but other than that, thank you all very much. And I make a motion to adjourn the investment committee meeting for today, January 20th, 2022.
22. I second it.
All those in favor?
All in favor?
Thanks, everyone.
Okay.
Take care, y'all.
Thank you.
Bye.
Bye.
Bye-bye.
All right.
Uh,